Edward Brown, host of The Best of Investing, here to remind you to tune in this week on Saturday at 8 p.m. Our guest is going to be Joe Downs. You're not going to want to miss this show. That's The Best of Investing on Saturday at 8 p.m. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. And today we do have a special guest, Catrina Kraft. The name of this episode is The Tax Game, the Wealthy Play That You Can Too. Now, here's a little bit about her bio. The tax code isn't fair, we all know that, but that's your opportunity as a business owner. This is the perspective, that Catrina Kraft brings as the CPA and tax strategist behind some of the most profitable coaches, consultants, and creators in the industry. After climbing out of $100,000 in debt and losing 80% of her income overnight, she rebuilt her business by using the same tax advantage strategies and wealth building tactics that the top 2% of the wealthiest rely on to protect and multiply their money. And now she teaches clients to do the same. Through her Kraft Money MAP TM system, she helps high-earning entrepreneurs cut taxes by 25% and boost profits by 20%. Strategies most accountants won't even talk about. All right, and when she's on the show, she's going to pull back the curtains of what the ultra wealthy know and how proactive tax strategy lets you keep more, grow faster, and build real wealth. And listeners will walk away with practical insights on entity structuring, overlooked deductions, and income planning that scales. Well, Catrina, that's a lot. Welcome to the Best of Investing.
Thank you. I appreciate being here.
So I before we get into our questions, I do have to ask you, and reading your bio, from $100,000 of debt and then losing 80% of your income overnight. How did you lose 80% overnight? What happened?
So I depended on one client.
Well, had a feeling.
80% of my revenue. So that was a life lesson and a lesson for business owners. Don't put all your eggs in one basket. And really diversify, your clientele, as well as I say, diversify the type of income that you earn.
It's funny. My dad was a CPA, and we talked about this in the 1970s. And he said, Edward, because I actually have a bachelor's in accounting and a master's in tax, so I was going to go into his business, and he unfortunately passed too early. But he had told me, he says, don't let any one client be more than 40% of your business.
Right.
And I understood why. I thought it's hard though, because if it's a big client and they're paying you well, what do? You don't want to say no.
Well, in this situation, sometimes you have to say, I can't accommodate 100% of what you do. Maybe you can outsource a piece of it so that you still have capacity. So if they have the bookkeeping or accounting, maybe you keep the tax piece and you can outsource the other part. At least then you still have capacity to work on other clients and continue to grow your business.
That's very good. I like that. Very good. Let's see. We got a quick minute before we have to go to a break here. What common mistakes do you see investors or high earners making when it comes to tax plannings that could be costing them significant money?
They are not planning. One thing you hear, what's the best time to plant a tree, now or 20 years ago. It's not too late, but you do need to plan. You need to have a roadmap so that you are making the right investments, because you could have the right investment per se, but if it doesn't fit into your tax situation and your tax strategy, it could always be the wrong situation. You could go from one tax bracket to the next tax bracket just by having a $2,000 increase. And so it's important to know your strategy and to look at it continually every quarter or every month, not just at tax time.
Okay. And we are in a progressive tax system, so that 2,000 only gets taxed at that incremental part, but we get the gist. Okay. Here's our first trivia question. And if you know the answer, don't say anything quite yet. We'll see if you can answer when we get back, but we'll see if the audience knows this one. Which is the largest joint in the human body? That's our trivia question. Call 888-912-1190. The first caller with the correct answer wins that tanning certificate, which, by the way, is worth over $100. Which is the largest joint in the human body? Call 888-912-1190 to answer that question. All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, along with my special guest, Catrina Kraft. First trivia question was, which is the largest joint in the human body? Katrina, do you know the answer to that? What do you think? You want to take a guess?
I do not know. I majored in accounting, not biology. I have no idea.
The knee. The knee is the largest.
Okay.
That was kind of cool. All right.
That's just-
Question number 2. How do you see proactive tax strategy influencing long-term wealth building compared to more traditional investment approaches?
Well, long-term tax strategy, you're looking at your complete picture. Like, where do you want to go in retirement, your goals, and you want to see the return on your investments as well, because you want to combine that with how much tax you may be paying. And it's
Yeah.
important to not just consider I'm investing for growth, but how is that going to impact your taxes? So you may think that investing in stocks may be the best answer for you because of the type of tax that you have with stock investment, but maybe real estate may be best. So you have to understand that there's different type of investments. You may have capital gains versus passive income versus ordinary, and all of those are important when you're making those decisions. And that's why it's important to understand the tax code and how the different taxes are done on different type of investments. So it can't just be I want to invest because of growth. You have to look at, well, how is that growth going to be taxed as well?
And this is just a generic question, and I know each person's personal situation will be different. There are a lot of people who say, don't do IRAs, do Roth, if you can qualify, do Roth IRAs. Pay the tax now and let it grow. Do you like that strategy generally, or do you like what, save as much taxes now as possible? Well, do you have a general?
I love the Roth. I love the Roth because it's going to grow tax free for you. And you can do a backdoor Roth. So even though you may make too much, you can invest in a traditional IRA, the next day transfer it or roll it to a Roth. That's called a backdoor Roth. So that gets you over that hump. Also, if you're a business owner, you can have your own 401k with a Roth option in your business. So again, that eliminates the higher income. And ask your company, if you are a W-2, if they have a Roth option. They may. A lot of businesses now have a Roth option. So that eliminates the income threshold.
So wasn't there talk about them getting rid of the backdoor Roth? But
There hasn't happened yet. The loophole was
Okay.
still open. They've been talking about it for a couple of years. But I think we have enough lobbyists that are maybe petitioning against it.
Well, it's funny. I've mentioned this on the show before, but you hadn't been on the show, so you hadn't heard this one. But my prediction, and I hope Congress is not listening to this, is eventually what I think they're going to do is Roths are going to get so big that the government is going to look and try to get their greedy little fingers on the money. And they'd have an absolute revolt if they were to say, we're going to change the rules. Sorry, guys, we're going to start taxing it. They won't do that. What they'll do is they'll say, well, you don't have to pay taxes on your Roth, but you have to tell us how much income and how big your Roth is. And then what they'll do is they'll apply that to other aspects, be it interest, dividends, Social Security, wages, whatever, to say, oh, we're not taxing you on that. We're just going to tax you on higher on everything else. Sort of like that.
They instituted that investment tax. So they may say, okay, you got to pay that 2% threshold, 3%, and just come up with the number for the Roth. So hopefully they don't do that. That would be a revolt for many people. That's been their retirement plan. And so if that changes, I can't even imagine what would happen.
And I'm trying to remember now, that 2 or 3% Medicare tax that they throw on for let's say interest and dividends, if you're over a certain threshold of that. But if you have, let's say, $500,000 worth of interest and dividends, but you have, $600,000 worth of a loss that you're allowed to take for, let's say, your Schedule C, so that you're negative adjusted gross income. You don't still have to pay that tax then, do you? Because isn't it based on your adjusted gross income?
Right. So you're going to qualify once you meet that threshold. So if that 600,000 for your business loss impacts
Yeah.
your bottom line, then you're not going to be thrown in that threshold.
Okay, well that's good. That's good for sort of thinking, just kind of thinking all this stuff.
Yeah. Since it's income based, then yes, that's, you have to
Okay.
have enough income. And if that 600
Okay. All right. Well,
reduces,
we're gonna continue on. Before I forget, though, because you're a wealth of knowledge. First of all, are you located in Dallas?
I am in Dallas, Texas.
Okay. All
But as
right.
a
Well,
CPA, I can work with clients everywhere and a tax
you go right
strategist.
everywhere. Okay.
Yeah.
So how do clients or potential clients, how does the audience get a hold of you if they have tax questions, or want to get in touch with you?
I'm on all socials. So socials would include Instagram, Facebook, YouTube, LinkedIn under Catrina M. Craft. And then if you want to just email me, I'm at hello@Catrina M. Craft. And Katrina
And
is with and Craft is
I was
with
just going to say that. See, I know that a lot of people don't know that, but it's Catrina with a C. So that's good. That actually differentiates you from the average spelling. So it'll be a little easier to find you probably. So that's Catrina Craft with a C. So C for Catrina and C for Craft. All right, here's our second trivia question. And again, as a reminder, Katrina, if you know the answer, wait till we get back and you can answer it. What country consumes the most chocolate per capita? All right. Call 888-912-1190. First caller with the correct answer wins that tanning certificate, which is worth over $100. What country consumes the most chocolate per capita? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with my special guest, Catrina Craft, who's a wealth of knowledge in tax and accounting. Our second trivia question, what country consumes the most chocolate per capita? What do you think, Katrina?
Colombia.
No, that'd be kind of interesting. You'd think because of the cocoa beans. Actually, Switzerland.
Oh, okay.
They make Swiss chocolate. Well, they make such good Swiss chocolate. You got to figure that they would be the number
Yeah.
one per capita. All right. So in your experience, how does using tax strategies change the way investors evaluate opportunities or allocate their portfolio?
Well, really looking at the tax strategies, as we mentioned before, looking at how it impacts some of your taxes. We talked about the investment tax. So, if you want
Yeah.
to invest in money type transactions, or if you want to go passive, where you can have real estate that's passive and you get great tax deductions depending on your income. It's really important to look at those to determine what type of investment is going to be best for you and your long-term goals. I mean, if you want something, they say real estate is passive. Believe me, I've had 12 rental properties. They were not passive. I mean, even with a property manager, you have to have some involvement
True.
in that real estate. So it's really like what type of lifestyle you want. What do you enjoy? Do you enjoy looking at stock charts and doing that type of investment, or do you want something that's easier, mutual funds? So I think really looking at that and then looking at how those are taxed. It's all combined. It's not just what makes the most money, because in the end, the net of that, you got to look at the net, including the taxes. What are you going to end up with? And then also, what do you love to do? And what do you hate to do? And then also, what's going to take up your time? Because that's important as well.
Yeah, because you can't get that back. It doesn't seem like sometimes if you fall into things, you go, I didn't realize it was going to take this much time. You always hear, I want to be self-employed so that I don't have to work as hard. And it's like, no, you end up working twice as hard, especially to have employees. Yeah.
Yeah, and
Well,
then as an employee or of your own company, you have one role. So you're really 5 employees. You're the janitor, you're the marketing, you're the CEO, you're the accountant. So you have 5
that,
jobs.
That is true. And then, what lessons can everyday investors take from how celebrities and ultra wealthy individuals leverage tax strategies to protect and multiply their wealth?
Yeah, so I've worked with celebrities. I've worked with Grammy Award winners and New York Times bestsellers and comedians, award winning comedians and actors. And so what I've learned is a lot of times they're in a situation where they get jobs and they have to learn to save because it's not a constant W 2 check.
Yeah.
So investors and also business owners can really learn from making sure that you have an investment plan, you have a budget. So when you have those high times of income, then you still have money that you can pay your fixed expenses. So you need to understand that, and that all comes with the planning. You need to make sure you're paying enough quarterly. So don't wait till the end of the year, and then you get a big tax bill because what's going to happen? You're going to have penalties for late filing, possibly late payment, estimated tax payment penalties, and then you have interest on top of all of those penalties.
Yeah.
So it's
Yeah.
important first to have a budget to save money so that you have it when it's time and needed in case you have low earning points in your business. And also you have estimated taxes and you pay them timely.
I remember in the old days when I was doing tax returns, a new client came and he missed paying his estimated payment by $5, and it cost him a $400 penalty because it was just,
Whoa.
did you pay what you were supposed to? No. Well, there's a penalty. He missed it by $5. And so, yeah, that's very good advice. In fact, in some cases you have to pay like 125% of last year's tax. I'm trying to remember, is that federal or California?
So on the federal, it's 110 to avoid the estimated tax
Yeah.
payment penalty.
And interest, nowadays interest rates in the bank are low enough where it's like, a lot of people say, well, I don't want to have them have too much of my money because, I'm not earning interest on it. But you know what? If interest rates are pretty low, unless you're talking millions of dollars, it's probably best, I think, also, it's kind of like a forced savings. Just pay a little bit more and just know you're covered.
Right.
That's,
Yeah.
that's very
It's
important.
100%, I think, of last year and 110% of this year. So it's two thresholds to avoid
Yeah.
the estimated.
Exactly. Yep. No, I hear you on that. I do want to make a mention here for Pacific Private Money. Go to them if you need a short-term bridge loan. If you want to buy your next house and don't have enough time to go to the bank, they can fill that gap by helping you buy your next house. And then when you sell your old house, you can pay them off that way, or if you refinance the new house, it's just a very good way of buying real estate. You can not only do it your own personal residence, but you can do it with rental property or commercial property. Check them out at pacificprivatemoney.com. Here's our third trivia question. What is the strongest muscle in the human body? That's our trivia. Now, we had two questions on the human body on this one. Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Let's see here. We do have a silly joke of the week also, which is last night I drank some invisible ink. And then when I went to the hospital, I was still waiting to be seen. All right. Stay with us. Don't take that dial. The best of investment. We're right back. Welcome back to the best of investing. Edward Brown here, along with Katrina Kraft. Our third trivia question: what is the strongest muscle in the human body? What do you think, Katrina?
I'm going to guess your jaw muscle.
Yes, very good.
I
That was
did
a
learn
hard one.
something in biology.
Yeah, I said maybe you should be a biologist. Yeah, the jaw muscle is the strongest muscle in the human body. Um, Okay, let's see here. If an investor or entrepreneur listening today wants to start keeping more of what they're earning immediately, what are the first three steps you would suggest they take?
You said a business owner or individual?
An investor or entrepreneur
Okay.
or business
Um,
owner, you tell us.
okay. What I would say the first thing you need to do is make sure your entity is structured properly. When
Okay.
you set up your entity, that is going to determine how you're taxed. It's going to determine what type of deductions you can take. For instance, you could be an LLC, but an LLC is taxed as an S corp partnership, S corp or C corp. So you have to elect how you want that LLC taxed. A lot of times, if you go to the attorney, they're not discussing that. That's a tax issue. So make sure you know that you're set up properly entity wise. Also, where you're set up, what state is important because there's some asset protection issues related to different states. That's important because you don't want to build your wealth and then you're subject to frivolous,
Sure.
lawsuits, and you can still be subject to them, but then you will be protected from those type of suits, your business and your
What states do you like for asset protection?
So we do a lot because I work with the asset protection attorney. We do a lot in Wyoming.
You know what? Interestingly enough, when I was mentioning off air that I set up an LLC, a specialized LLC, and I actually, Wyoming, that's why I set
Yeah,
it up. And it's funny because I didn't set it up because of, I didn't know about that part of it. I just knew that their fees were low and there's no income tax, I believe.
correct. And
Yeah.
the privacy is there. So
Yeah.
they want to disclose who the owners of the business is. So you have the privacy. That's very important.
That's good. And I think, what is it, just once a year you have to file something with them?
Yes.
Yeah, I
A lot of
literally
states, a
just
lot of
looked this up a
states
month.
though, but yeah, you have to just file something with the state.
And that's just once a year at the end?
Yes.
Yeah, gotcha. Okay. Yeah, you always want to make sure you keep it in good standing. What a coincidence. That just happened. I'm thinking, I hope she says Wyoming. But it's funny because I think they have the smallest per capita state, people in there, but I like those laws. That's pretty
Yeah,
good.
a lot of businesses are there. Now, if you're trying to maybe go public, you may want to do Delaware. If you
Yeah.
plan to sell your business. So it just kind of depends on what you're looking to do.
Didn't Elon Musk say he just kind of moved out of Delaware because there was some crazy stuff going on? I,
Oh no, I haven't heard that. I'll have
I
to look
think it
it up.
was. I mean, in the old days, it was like everybody set it up for Delaware, and I couldn't remember the reason
Mhm.
why, but it was there
Okay.
was Delaware was like that was the state to set up your LLC, but now it seems like Wyoming's our favorite state.
I'll have to look into it to see if, there are some things that, states change. So they could have some
Yeah,
rules now where things are more open.
yeah, exactly. Let's see, what else you want to go? How do you see tax law changing? New administration, good tax planning tips for the audience.
Well, I'm sure everyone knows that the one big beautiful bill passed. And in that, there was some great tax options for business owners. Like now we have back, we can get the heavy SUV or truck and get that deduction, that large deduction. I just talked with a client. He's buying an automobile for 75,000, writing off 100% of that. He's in the
Yeah,
32% bracket. And so, he has a marginal tax rate that's going to allow him to save $21,000 in taxes. So I love
nice.
that. The QBI deduction has increased and it was made a permanent. So that's huge. That's a deduction for S corps.
Yeah, what are
Also,
the qualified business income deduction? What did they?
it was
It was
it was
20%.
20%, went up to
Yeah,
23%.
23%. Okay, but there's still limitations, right? I mean, if you make too much money, you don't qualify for it, right? Have they
Right.
changed
They
those?
still have limitations based on the type of business you are. So, like a lot of professional services, we could
Yeah,
be limited depending on
yeah.
what you provide. So, there are still limitations, of course, depending on if you're a professional service provider.
And also an income. It's like it used to be like 315,000 or something, and I don't know if they raised it to
Yeah.
351. There was some kind of limitation on the
Yeah,
amount of
that
that.
income limitation is still there. Yeah. So, there's different income limitations that you need to, look out for.
Yeah, boy, I tell you, it's so funny when I used to give tax advice and people would ask me what the rules are. I'd always have to say, well, I got to check because it changes all the time, you know.
It does.
But
I mean,
yeah,
and that's why you have to have a tax strategist. The tax code is over 6,000 pages. And then with the regulations and guidelines, it's like they say 70,000 pages. And it's
yeah.
always changing. It's so complex. And
What-
you really have to have someone that's just keeping up.
So I'm going to guess that I'm older than you. And when I was in school, we were working with the code of 1954. So yeah, in
Ah,
fact, they had just changed it like not too long before that from the code of 39 to when they finally came out.
wow.
I mean, I wasn't in school in 1954. I wasn't born yet, but yeah, we were working with the code, and we had 2 volumes, and it was still thick even back then. All right, audience, no trivia question, but stay with us. We'll be back with some closing comments and our fun thoughts for the day. Welcome back to the Best of Investing. I'm Edward Brown. The last time for today, I'm Edward Brown. This is and Katrina with my special guest Katrina Kraft. No trivia question, but Katrina, what do you put on your crystal ball? What do you see futuristic with taxes? Because there's estate taxes, and we remember in 2010, I think it was, George Steinbrenner timed his death perfectly because the no estate taxes, no matter how large it was. What again? This is nothing set in stone. Just kind of getting a feel for what you think is going to happen futuristic wise, tax wise.
Well, I think the estate tax is going to still be a larger amount before you hit the estate tax. I just don't feel like we're going to be able to tax people on their estate at a lower level.
And I
There's
think it's
more methods. Yeah,
Yeah, I mean, I think it's terrible. It's like, it's already been taxed, and now
correct.
just if you want to give it away to, your families, it's like, no, no, no. I mean, how much more socialism can you get than that?
Right. I don't understand that. That's
Yeah.
crazy, you know? And so people are looking at how can they maybe give to charity and then that amount when they die, they can get some step up in basis
Yeah.
charity they sell and then they can still sell get the donation deduction. So people have to look at other ways when they're subject to the estate tax. Also, I just feel like AI is going to be huge. I know that the IRS, they hired a lot of people, then they fired a lot of people,
Yeah.
and then they
Yeah.
hired some people back. I actually have 2 family members that worked with the IRS, and they were laid off, and now they sent them notices to come back. And so what I found during that period, it was a period where it was so hard to get in touch with the IRS. So audits were down. And then we were thinking audits were going to come back up because they hired a lot of people. And now I just don't know what's going to happen with the IRS. It does need some type of overhaul
Yeah.
because, systems are old. Um, I don't know if they'll start using AI at some point. It may be 30 years down the road. They're,
Or maybe you'll go to like a national sales tax or something, which,
I
I
don't
don't
think
know. You don't
that'll,
think so?
no,
Yeah,
I don't think.
yeah, it's what they'll do is they'll do that and an income tax. It's like the
Yeah.
tax. Like, Beatles were right. They'll tax the air that we breathe. They're always looking for ways to tax more, not which is kind of interesting because when we get to our thoughts for the day, you kind of see what I think here. But kind of interesting. We only have about another minute. Why don't you give out your information one more time? You're quite knowledgeable in your wealth of knowledge with income taxes. So how do people get a hold of you?
Yeah, so again, you can reach me. My website is actually Katrina M. Craft, and I do have a newsletter that talks about tax and wealth tips. So if you go to katrinamcraft.com and subscribe, then you'll get on the list to get additional wealth tips. I drop videos in those. And I
Yeah.
also have a podcast that I'm not doing as much, but I have a lot of episodes already, like 7 months of episodes, and it's Craft More Cash on all the podcast sites.
And that's Katrina with a C and Kraft with a
Yeah,
C.
craft.
Yeah, no, we like that. All right. And let's go to our thoughts for the day. So, what if my dog only brings the ball back because he thinks I like throwing it? You ever think about that? And why does, and this kind of goes back to the economics and taxes that we were talking about. Why does a slight tax increase cost you $800, but a substantial tax cut saves you $30? Interesting how the government does that. They get
Yeah.
kind of a sleight of hand, so to speak. Yeah, what is it? You'll own nothing and you'll like it. It's like, no, I don't think so. All right, audience. Next week, too, the best of investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.